Hi traders, and welcome to the next video in this course on intermarket relationships. So in this section of the course, we've already talked about a few intermarket relationships that we have. There's hundreds that we can go through, but examples of some of the ones we've already looked at are when we talked about rate hikes and rate cuts. We said that that's going to impact the demand for bonds and the flows in and out of the bond markets. Now, if you have higher rates, it's going to increase the demand for bonds. You'll see more flows going into bonds. That could increase the demand for the corresponding currency of that country. It could also lead to an outflow from equities. So those are two intermarket relationships that you've got there: bonds and stocks, and bonds and FX. Now, that's a fairly broad relationship that you have between those two asset classes. You could get something more specific. For example, let's say you take stocks, and let's say you take the company Apple and Samsung. They're big rivals in the smartphone market. Now, if Apple releases a new model of their iPhone with a major upgrade, the markets might start thinking that, okay, we're going to see greater demand for the iPhone. Apple will increase their market share in that industry, and as a result, Samsung will lose some market share. So you might see Apple shares going up and Samsung shares coming down. So you could get something more specific like that. Now, in this video, we'll take a look at some of the intermarket relationships that we tend to look at on a regular basis. As I said, there are hundreds out there, so you'll learn more throughout your trading career, but these are the main ones that we tend to focus on from a global macro perspective. So the first thing we'll look at is commodity currencies. When we trade FX, we focus on the G10 currencies. So that's going to be the US dollar, the Canadian dollar, the euro, the pound, the Australian dollar, the New Zealand dollar, the Swiss franc, the Japanese yen, the Norwegian krone, and the Swedish krona. Those are your 10 currencies. They're the ones we focus on, and out of those 10, 4 are what we call commodity currencies, or high beta currencies, or risk currencies. Now, the reason why we say that is because these currencies are correlated to the commodities markets. And commodities, they generally move in a positive correlation with the economic cycle. So when the economy is doing well, most commodities tend to do well. There's greater demand for them, so they go up in value, and vice versa for when the economy falls. Now, that means that these currencies, typically, because they're correlated with these commodities, when the markets are in risk-on mode, when there's a greater risk appetite, these currencies tend to move along with these commodities and move up in value. And then vice versa for when those commodities are moving down. And something we've talked about in the last 3-4 videos is the reason we're looking at some of these areas in the markets, things like equities, bonds, derivatives, is one, we need it for our analysis, but also later in our trading career, as you get more experience and once you familiarize yourselves with something like FX and you're used to trading FX, you might want to add something like options or stock indices to your available product range, to the assets that you can trade and execute your trade ideas from. So in the same way, these commodity currencies could be used to give us exposure to something happening in the commodity space without actually trading those commodities. Now, why would you do this? It could be just that you're used to trading FX, you're familiar with FX, so you don't really want to go and trade commodities directly, or you haven't learned yet how to trade commodities directly. It could be that you want a bit of a limited exposure to the commodities market, and these currencies act as a proxy to get involved in some of those other markets. It could be that you have something positive happening in a certain commodity, but you also have something positive happening with a corresponding currency. So, for example, if you look at the first one here, you've got Canada, the Canadian dollar. it's correlated with oil because the Canadian economy exports a lot of oil. Now, imagine a scenario where you've got tight oil supply in the markets, but demand is strong. So if supply is low and demand is strong, so if demand exceeds supply, that means that, going back to our law of demand and supply, the price of oil is going to move up. The Canadian dollar is likely to move up along with oil prices. Now, along with that, let's say you also had the Bank of Canada hiking rates. This is another positive factor for the Canadian dollar. So you might be better off trading the Canadian dollar because there's going to be greater conviction in that trade compared to trading oil directly. So there could be a number of reasons for why you want to go in this direction rather than trading that commodity directly, but ultimately it just gives us extra tools that we can use. And we're also being made aware of some of the factors or some of the risks that we need to keep in mind when we trade these currencies. So again, let's say the Bank of Canada is hiking rates, you go along the Canadian dollar. Now, if you know that it's correlated with oil, you know that you need to keep an eye on the oil markets as well, because if something negative happens there, that could push the Canadian dollar lower, in which case you might want to exit your trade. So that's the first relationship that we have. The second one isn't a massively strong one, but it's between the New Zealand dollar and dairy. New Zealand exports a lot of dairy, and if you look on the economic calendar, you'll see that there's dairy auctions every other week for New Zealand. So from that, you can gauge how strong the dairy demand is. And it's really only if you see massive deviations will that move the New Zealand dollar. The factor that's probably going to be bigger for the New Zealand dollar is the next currency we're going to look at, which is Australia, or the Australian dollar. Australia export a lot of iron ore. So if iron ore is moving up or down, the Australian dollar will move along with that. Now, the reason why I say that New Zealand is probably going to be more impacted by what's going on in Australia is because, firstly, they do a lot of trade with Australia. Then Australia do a lot of trade with China. Australia export a lot of their iron ore to China. So what that means is if the Chinese economy is weak, they are probably going to import less iron ore from Australia. So then that impacts Australia negatively, because it means that demand for their iron ore is going down, and that will bring the Australian dollar down. And then because New Zealand does a lot of trade with Australia and China, they're going to be impacted because the Australian economy is now weakening. They're seeing weaker demand, so they're going to be importing less from New Zealand. So it's a bit of a circle that's then formed there. So you've got to be aware of these types of relationships as well. The relationship between two different economies. So that's Australia and iron ore. And the final one is Norway, which, like the Canadian economy, Norway export a lot of oil as well. So those are the four commodity currencies you have in the G10 FX space. Now, just to give a quick rundown of why is it that these commodities will impact the currencies. So it's very simple. If you take oil, that's probably the best one to use. And if you take Canada, they export a lot of oil. Now, they're going to ask for payment in Canadian dollars. They could even ask for payment in US dollars, but eventually they're going to convert those US dollars into Canadian dollars because that's the currency they need in their country. So either way, when they sell oil, whether they receive US dollars or Canadian dollars directly, ultimately it's going to create increased demand for the Canadian dollar. So the Canadian dollar goes up. Now, if oil prices go down, the amount of money you're collecting is going to be less. So that means the demand then for Canadian dollars is also going to be less, which is why the currency starts to come down. And the same thing applies for all of the other currencies. Most commodities will be priced in US dollars and traded in US dollars, but ultimately that conversion eventually needs to take place from US dollars to Canadian dollars, or to New Zealand dollars, or Australian dollars, or whatever currency it is that a certain country is using. So these are our commodity currencies, and they tend to move up and down with risk sentiment in general, because commodities will move up and down with risk sentiment. The next thing we're going to look at is safe haven currencies. Now again, we're sticking to the G10 FX space, and in that space there are three currencies which are considered to be safe havens. The first is the US dollar, the second is the Japanese yen, and the third is the Swiss franc. So what we normally see is that when there is something negative going on in the world or in the market, you typically see strong demand for these currencies. And the reason why is, firstly, with the US dollar, it's the world's reserve currency. The US economy is the world's biggest and most stable economy. They have a stable government. They've never defaulted, the government's never defaulted on their debt. So it's considered to be one of the safest places you can put your money in the world. And as we've said before, the US treasuries are considered to be the safest government bonds that you can buy. So that's where the safe haven characteristic for the US dollar comes from. The second is the Japanese yen. Now, why is the Japanese yen a safe haven? So the reason the Japanese yen is a safe haven is because they are, firstly, a net creditor to the world. So how are they a net creditor? Now, these other countries, like the United States, for example, they issue government bonds. Japan do that as well. But Japan, or investment firms in Japan and banks in Japan, they buy a lot of these international government bonds. They'll buy a lot of US treasuries, or they could buy a lot of UK gilts or European government bonds. And on a net basis, they are actually lending more to other countries than they are taking money from other countries. So that is what makes them a net lender. Now, they do have debt. They have government bonds and they do have debt, but most of Japan's government debt is held within Japan itself. So what does that mean? The buyer of most Japanese government bonds, most of them will be bought by Japanese investment firms. So firms within Japan. And what that means is that it's very unlikely that you're going to see a lot of major selling of these bonds and basically people asking for the Japanese government to pay their money back, because the companies who hold that debt, they are within Japan. So if they do that, they are going to cripple their own government, which means they're crippling their own economy, and they're just bringing the roof down on themselves, which is why the Japanese yen is considered to be a safe haven. It's also got a fairly stable economy and a fairly stable country. So that's the Japanese yen. And the final one is the Swiss franc. The Swiss franc is a safe haven because it's, again, stable economy, stable government, stable country. It's considered to be a fairly safe country. And one thing I forgot to mention with the US dollar is, if there was, let's say, worst case scenario, you had a major world war breakout, World War III, it would be expected that the US, with all of the money and all of the military equipment they've got, they would win that war, or whoever's on that side would win that war. So that's another reason why the US dollar is considered to be a safe haven as well. Now with the Swiss franc, they don't really get involved in physical confrontations. They like to remain neutral. So that's why they're considered to be pretty safe, because whilst there could be another war going on, the Swiss economy and the Swiss government is unlikely to get involved in that. So that's another thing that attracts and appeals to investors. So these are your safe haven currencies, and when you have risk off in the market, they typically tend to see inflows, but Remember, these are not the only factors that drive these currencies. There's also other factors we've got to consider, but usually these are the types of links that we see. So for example, if you had something negative going on in the world, if you had risk off in the markets, then quite often what a lot of traders will do is they'll pair something like the Australian dollar, which is a commodity currency, a high beta currency, with something like the Japanese yen, which is a safe haven, because you've got a reason for outflows from Australia, but also a reason for inflows into Japan and the Japanese yen. So that's where you could see the stronger movement compared to if you were trading something like, let's say, the pound against the yen. So those are our safe haven currencies. The next intermarket relationship we're going to be taking a look at is gold and silver, or precious metals. Now, there are a couple of other metals like palladium and platinum, which are classified as precious metals as well, but we don't usually pay too much attention to those. Now, what you'll see quite often is that gold or silver, more often gold, they'll be referred to as an inflation hedge. So when inflation is going up, these are the commodities you should hold because they retain their value. We talked about the other currencies typically following the economic cycle. When the economy does well, they do well, and when the economy is not doing well, they don't do too well. Gold and silver are a little bit different. They are a bit of a safe haven. So when things aren't going so well, they typically go up in value. When the economy is not doing well, they typically go up in value as well. So that's why they are called precious metals. And they are quite different from other commodities. But the mistake that a lot of people make is they call gold and silver an inflation hedge. Now, it's not exactly a mistake to call it an inflation hedge, because if you look over the long term, if you look over 200, 300, 400 years, then yes, gold has retained its value, it's preserved its value, it's moved in line with inflation. However, if you zoom into that chart a little bit more, you'll find a lot of periods where gold doesn't really correlate with inflation so well. So over a very, very long period of time, gold retains its value, but it has a much closer correlation to US real yields. Real yields are where you have the yield on a bond and you adjust that yield for inflation. So if a bond is giving you, let's say, a 5% return, inflation is 2%, your return there is 5% minus 2%, the real return is 3% when you've adjusted for inflation. So what we normally see is that gold and silver will move in the opposite direction, so with a negative correlation to real yield. So if real yields are up, gold tends to move down, and if real yields are down, gold tends to move up. Now, the reason for that is if the real yield you're getting on a bond is good, then investors are not so worried about preserving the capital. They're going to focus on making a bit of a positive return by investing into those bonds. On the other hand, if real yields are not great, or if they're negative, then the first goal for a trader or an investor is always to preserve your capital. So that's where gold becomes more attractive, or silver becomes more attractive, because you put your money in there to try and retain its value. And because of the correlation, gold typically, or even silver typically, they tend to move higher. So you could even make a bit of a capital gain. It's also worth keeping in mind that, like the other commodities we talked about, gold and silver, the benchmarks are priced against the US dollar. So when you're looking at gold or silver, think of it like a currency. It's gold, US dollar, or silver, US dollar. So you've got to consider the US dollar side of the equation as well. And if yields are going up, then it's going to create more demand for those bonds and those and that currency. So the US dollar goes up and vice versa. So if the US dollar is going up, then gold, which is priced against the dollar, is going to go down. And if the US dollar is weakening, then gold is going to go up. So it's a sort of a dual impact that you're getting there from the currency and also from the bond markets. So that's the relationship between precious metals and real yields. As I said, in the long term, in the very, very long term, precious metals will retain value, which is why they can be used for capital preservation. But there's a much stronger correlation with real yields where inflation does come into play. But the correlation is a lot stronger there compared to if you're just looking at inflation alone. And the final thing we're going to take a look at is the carry trade. This is a very popular trade in the FX space. Now, what the carry trade is, this is basically where you take advantage of the interest rate differentials between two different countries to generate a positive return. So, for example, Japan typically has low interest rates. So what an investor will do is they'll take out a loan in Japanese yen, where they've got to pay a low amount of interest on that loan. And they could take that money and go and put it into somewhere like, let's say Australia, where the interest rates might be about 3% higher. So they collect positive interest from their investments in Australia. They use some of it to pay the interest they've got to pay on the Japanese yen loan they've taken out. And the rest they are able to keep for themselves. Now, this is usually done through government bonds. So they'll take the loan out in yen and then go and invest it into Australian government bonds, or it could be another instrument. It could be commercial bonds if they are fairly stable and if the investor wants to take a bit more risk. But the idea is that you take advantage of the two different interest rates and you use the lower one to borrow money, and then you invest it into the one that's paying you a higher return, and you collect a net positive interest on that investment. And it's usually done for a long period of time. It's a long-term investment. Now, again, there's a lot of other things you've got to consider, not just the interest rates. You've got to look at the fundamentals for both countries as well and think about what about the exchange rate risk? Is the Australian dollar going to either remain around the same level with the Japanese yen, or is it going to get stronger? Because if it gets weaker, that's pointless, because it means that you make all of these positive returns through the interest rate differentials, but then you lose it because of the fluctuations in the exchange rate. But if the Australian dollar remains around the same level against the Japanese yen, or it gets stronger, then for the investor, that's better. So they are looking for a capital gain or capital preservation in that FX trade, along with collecting the interest rates. Now, in our trading accounts, we can actually do this as well, because your broker will often charge you an overnight swap, or they'll pay you an overnight swap. And provided that the interest rate differential is large enough, and you're trading in the correct direction, so you're long on the currency, you're buying the currency that has a higher interest rate, your broker will pay you a positive swap on that trade. So it's something that we're able to get involved in as well. And this can be something to think about, because if we are getting into a trade for a medium to long-term position, we've got to think about what direction we're trading in and what is the swap rate. Are we going to be charged a swap, or are we going to be paid? If you're getting paid a swap, then you have an incentive to just keep holding that trade until it plays out, provided that the fundamentals remain intact. On the other hand, if you're being charged a swap, then you've got to think twice about how long you really want to hold that trade. Because if you've got to hold it for a long time before the fundamentals start to play out, you're going to be paying a lot of money to keep holding it. So you might be better off cutting the trade and then looking to get back in later on. And again, you've also got to think about the which way is the actual asset going to move. You're trying to make a capital gain on that trade as well, because there's no point of you making a capital loss and then collecting positive swaps, because that will just cancel each other out, or you could end up with a net loss. So that's the carry trade, which is very popular with investors. And in our example, we use the Japanese yen and the Australian dollar, but quite often the way that carry trade works is investors will use something like the Japanese yen where rates are normally low, and they'll go put into emerging markets where rates are typically high. So that could be somewhere like Brazil, Turkey, India, Mexico. Those emerging markets typically have higher rates. So that's where investors will go and put that money in. Now, emerging markets are typically riskier as well. So what you tend to see when you get risk off in the markets is you'll see something like the Japanese yen then strengthen because people are unwinding these positions. They're selling their investments in these emerging market countries and those currencies, and they are now buying. They are now bringing it back into Japan and basically just doing the reverse of the initial trade. So that's another thing that can make something like the Japanese yen and the Swiss franc move up during times of risk off in the markets, along with the other safe haven factors. Now, in recent years, the Eurozone, the ECB, they've had low rates as well. So the ECB has at times shown safe haven characteristics where when you've got risk off, you see an unwinding of those trades. So the euro can sometimes strengthen. Now, as I'm recording this, we haven't seen that correlation as much, but it is something relatively new and something worth just being aware of because the ECB does use negative interest rates. So that makes the euro quite popular for the carry trade as well. So these are examples of some of the major intermarket relationships that we tend to see on a regular basis and that we need to be aware of. But remember, I said at the start that there are hundreds of these types of relationships out there. So you learn about more, or you'll need to go and learn about more of them, depending on what markets you choose to trade and the type of trader that you decide to be. So that now brings us to the end of this video. Thank you for watching and see you in the next video. Cheers.